Hello everyone, this is Joey, founder and creator of myatwm.com. Um, just to get the disclaimer out of the way, this is not investment advice. It's for entertainment and education purposes only. We are not licensed investment advisors. So, moving on, I wanted to go ahead and make this quick video on NVAX. This idea actually just occurred to me today, and I'm not quite sure why I didn't put the two and two together before. Before, I was always focused on lowering the cost basis by dollar cost averaging, basically, and it just occurred to me that there's another safer way to do this, but can actually, turn a losing stock into making money while it's going down. Before, let me just go over to the cost basis so I can just show you where we're at on this, is NVAX. So basically we have 300 shares we own, and we had a put contract on there, and that's still active. It expires tomorrow. But before, I was targeting this cost basis as 28 to basically sell 3 call contracts for covered calls at that, but it wasn't worth much money. Matter of fact, I traded it a couple weeks ago for like $10 a piece, so $30 total to expire Friday, or not tomorrow, but the 16th, the next Friday out. Anyway, what the idea is, or the strategy is instead of waiting for the cost average, you can see that I purchased this set of 100 at 21, purchased this set at 24.50, and that set at 19. So instead, what I'm going to do is sell a covered call, just one contract at 19, collect a lot more than just $10, and it'll expire, in less than a week. And then the same for 21, the same for 24.50. And this way, even if I do get called out, I get called out for the same price that I bought it for. So that's a wash. But I've gotten more cash flow, or I've gotten cash flow while I've had it, which is the whole idea of this principle or this strategy anyway, is to, for cash flow of the stock. And by the time it reaches up 21, or even here, my overall cost average, because I hadn't been doing it this way entirely, and I got called out way below my cost basis previously, like a month or two ago. So I still have to play some games on the higher one, but by the time it gets closer up to this, higher than the strike price will be selling for more premium at that time anyway, so I could probably finagle it that way. But until then, I can go ahead and make premium on these lower ones fairly easily. So that's what we're going to go ahead and do while the market's still open. I want to go ahead and record this video real quick and show this strategy in play here. So what I'm going to do is come to NVAX. I already sold the other one back. I had to sell it for $12, so I got it for I sold it for 30, and I bought it back for 12. So we did still pocket $18 there. So that's cool. All right, so we're going to trade NVAX options, and we are looking, let's start with the cheapest one, $19 strike price for one contract. So we want to sell a call, and we're not going to do it for tomorrow, because tomorrow there's not much premium left. So let's go ahead and go out to the 16th to get a full week in there. So we're looking for 19. So 19 is right here. So see that we can get $58, and before we were only going 10. So, and it's going up probably because the price is going up. So that's cool. Yeah, it's going up. Okay, so let's go ahead and do this real quick. So 60. Let's go ahead and try and do 62. Let's see if we can get that and do one contract. Give it a second. Oh, it looks like it might not take, so let's cancel that real quick and go back down to 61. Submit that. Okay, see, that one got filled. Okay. All right, so that's one contract. So let's go up to 21. So we're going to sell a call December 16th, go up to the 21. So we can get like 24 for it. There's a spread there, so let's do 0.26 to meet in the middle. See if that will fill. Submit that. See, that one filled. Nice. Okay, and then moving on to the last one, 24.50. Same sell, call, same one out there. So 24.50 is right here. It says we can get 7 for it. And again, see, we're just selling it a week, so it's a week at a time. So we can adjust this after a week, and it'll probably be worth more if the price has been going up. So that's the whole idea. All right, and yeah, 7, 8. So that's not a big spread. So let's go ahead and stick for 7, and we will submit that. Again, just one contract. It'll probably get filled. Yep, it should get filled pretty quick. Okay, and it did. All right, so there. So now we have gone through, sold that 3 contract call at 28 back for 12, and we sold 3 individual calls, one at 3 price points, 3 strike prices, one at 16, one at 21, or sorry, that's the put. Sorry, the 16 is the put. Okay, one at 19, one at 21, and one at 24.50, and we collected 65, 28, and 8 for that. So what is that? 85, 74, 70. I don't know. Can't do that. It's like 82 cents, I think, almost $82 that we just created there, up from the 12 that we bought it back from. So that's a win in my book. And not to mention, if we do get called out, we're just getting called out at this point, 19 for what we bought it for. So that's a wash, and we just pocketed all the premium that we've ever collected from that. Same for at 21, and same for at 24.50. So that's a way for us to keep on getting cash flow, keep on bringing in cash flow on both sides, because we're still playing the put side. We're just doing one contract of the put, because I mean, unless you got a bunch of capital, that's, probably the best case scenario that you can do on both sides. And I like playing the put and the call, because one side is 100% going to win all the time. So in any case, I just wanted to show you guys that. I'm going to go through and grab the history and go ahead and add it to the cost basis here, because it executed. So let's go ahead and do that real quick too. Okay, so what I've done is I've gone ahead and gone to the Robinhood transaction downloader, and I've gone ahead and downloaded those transactions that we just did, and I'm going to go ahead and enter them into the web application. So that's here. Okay. All right, so we're on NVAX, and we opened 3 new positions, but let's go ahead and just do them one at a time. So the first one was a call. So all of these are calls, and all of them expire this Friday. All right, so let me go ahead and just prep all 3 of them. So we did it today. We did a sell to open on all of them, all 3 of them. All 3 of them were calls, and they were 1 contract each. The expirations are all the 16th. All right, and the strike price for one of them was 19, and I can actually go by here because I know I did it for those, 21 and 24.50. All right, and so the price we got for the 19 is right here. So we got 61 for that. So go ahead and click save on that. And then for the 21, we got 26. Save that. And then for the 24.50, we got 7. All right, so that saved those 3, but it just added the proposed records. We need to add it to the transaction history too. So go ahead and move the 61, save it, move the 26, save it, move the 7, save it. All right, so that's like 87. Oh, 87.94. So we pocketed $94 minus the 12 it took because we had to return or buy back the 3 call contracts. So anyway, that added it, and that was like another $100 almost, another $90. So I think that is doing nicely. All right. So if we go back to the dashboard and we go back to the premium, yep, we can see it was 140 before, now it's 223 that we've collected. So that's a way to eke out some more profit on a stock that has gone down in value. I'm going to go ahead and start applying the same principle, same strategy to the other stocks. The only other one that I think I could probably do this on that I actually haven't looked at yet is rum. Rum, we have, so we have those 2 call contracts, So we might be able to do the same thing on here because this one was at 10, 13. Yeah, we got 2 at 10 and 13. And so these strike prices, see, they're all the way up at 12, 11.50. So yeah, there might be some extra money we're leaving on the table there possibly. So, yep, I will wait until these things expire because, oh, well, this one expires tomorrow, but see, now this one doesn't expire till the 23rd, so I might look at possibly buying this one back. It's going to have to be worth some serious money to do this because to buy back the rum contracts, unfortunately, they only do it in nickel increments, so I'll have to look at that. But anyway, this video was primarily focused on NVAX, and I've shown you how you can collect some additional premium that you may not have realized you can actually safely get without losing any of your capital, assuming you played it from this way from the very beginning, which I will actually start doing. So it's kind of like this put. If this put expires in the money, so let's see, right now the last price is 17.20, so I don't know if it'll drop down below 16 by tomorrow. It's NVAX, so it could. NVAX is very, very volatile. But so basically, if it did drop below, so we had to purchase it at 16, then I can turn around and sell a put again at whatever it's, say it went down to 15.50 or 15, I could sell a put at 15. But I can turn around and instead of taking the cost basis with the 16, which lowers it down to, I think, 25, instead of looking for a strike price up at 25, I can actually just turn around and sell a call right back on it at 16 again, which is going to be really close to at the money. So it'll be a very high premium, probably close to $100 or so. So yeah, you can collect some serious premium doing it this way. And all you're really out is the fact that if your highest purchase price was like $28 or $39 or whatever, you can't sell a call at that price really and get any premium. I mean, you'd have to go really far out and it'd be really, really low premium. But it's just on that contract or that 100 shares that you bought way out there, assuming you'd done it this way. So anyway, that was it. That was all I wanted to show you guys. How I churned NVAX, tanking basically. It tanked a little bit more than 50%, but we're still making some pretty decent premium on it, which is the name of this, or the reason for this principle or strategy that we're doing. Thanks again. Talk to you guys later.